Good evening, ladies and gentlemen. Today is the Wednesday, the 16th of June, and one day before the expiry. I haven't taken many trades in the past 2 days, and if you follow me on Twitter, you'll get to see that. In the past 2 days, the risk reward equation didn't just sit very well, and given that we had conflicting data at different times, which showed uncertainty, and overall didn't look very good to trade with a sideways view. Um, I didn't end up trading as such, and I post early in the morning itself if or not I'm going to be trading that day. So you can follow me, and certain trades that I taken, this Adani trade that I took yesterday, is doing quite well. It's returning about 8% in just one day because of a very high IV spread. I generally post if I'm not going to trade or if I just take an entry and exit really quickly because it doesn't make sense to stay in the trade. You can follow me on Twitter and keep track of that. But apart from that, today was an all right day. We opened slightly gap down, made a big up move. Up move got sold into heavily. Support that was expected to be there broke down, and then once again we saw a reversal. So it was relatively tricky. I closed mildly in the green and I closed quite early because at that point it just didn't make sense to stay in the trade with a given premium, as well as the risk reward just not being that good anymore towards the end. And yeah, that's more or less the summary. I hope you had a good trading day. We were relatively range bound, but with quite a few volatile spikes in either direction. I will be closing my calendar spread position towards the end of today. It's not yet 3 o'clock, and will reinitiate it tomorrow after the expiry. I'm expecting that if not much comes of the Fed event later today, then that should lead to a further decrease in IV, which is why I'm not holding the spread overnight. Thank you so much for watching, and I will catch you tomorrow for the expiry trade. Take care.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. We gapped down for the day with US markets closing slightly in the negative yesterday, and currently global futures also trading slightly in the negative. Um, and that being the case, entered delta neutral triangle with a slightly positive delta at entry, keeping a 200-point width. Entered the 15750 put at 32 and 15950 call at 17. Now we've had some immediate up moves post that, so I'm expecting 15800 to be a support on the downside and 15900 to be a resistance. And to play that, this is the position that I have taken. So I'll keep you posted. The time is 9:27. More or less, this will be the entire range that I'm working with, keeping a 50-point buffer in either direction. And in case we start to break either the given support of 15800 or resistance of 15900, we'll switch around some position to neutralize the risk in that direction. Okay, so it's 10 o'clock and looks like we are heading towards Monday's close. Reliance has been quite weak and might have downside all the way till 2200. Now, if Reliance heads to 2200, that means we will head to 15800 on the spot. Bank Nifty IT looking kind of weak after the gap up, but still flat, so not particularly of too much concern. Right now, the idea will be to wait and see. If we test 15800 on the downside, then I will square off the 15750 put and roll it to 15700. So that's more or less the plan for now. We are essentially, so what has happened is initially in the day we had 15800 put being written quite aggressively, but into the dip, quite an unwinding, and 15900 is starting to solidify as a call side resistance. So that being the case, one option would be to risk off half the puts now and the other half later, but I will wait for 15800 to actually get tested before doing any of that, because it would seem far too obvious in this situation that we make a test of 15800, which is why it might not happen. There is a slight pullback I'm going to use that pullback to slightly risk off on the puts, giving me a little bit more room for put side expansion if there is a dip at any point to 15,800. On a green candle, a lot of the put side stop loss is hit. So that leads to a sudden drop in the put price, at least to some extent. And that is generally a better time to risk off than risk off into when everyone is aggressively buying puts. Yeah, so I've taken the risk off from here and moved it here. Could have done a slightly better job of the pricing by while shifting, but can't be helped. So anyway, now that gives us far more room on the downside, and if we do test 15,800 now on the downside, we'll move down half the calls from 15,950 to 15,900. We were making a test on the downside of 14,800, so we'll be moving down half of the calls to 15,900. We are not the best pricing, but needs to be done in order to uh, protect against a further down move. We already risked off on the puts earlier on a green candle, and that's why we got very good pricing on the puts. But now with this test of 15,800, could be a further unwinding. I don't want to sit in the way of that, which is why half the calls have been moved to 15,900. Now, if we start to rise again, we start heading over 15,850, then we'll have to again take these calls and move them back up here. So that'll be the plan of action in case we start making an up move. But if we have a continued down move, have like 2-3 candles below 15,800, then we'll take the remainder of the 15,950 calls and move them to 15,900. Now, clearly we have 15,900 solidifying. The reason 16,000 call isn't the maximum OI is because it's just not that much premium in it. So there's no premium in it. People are not going to sell it. And yeah, so sorry, 16,000 is not because there's not much value in it, and 15,900 is where positions are building up. So yeah, we'll keep you posted. We'll most likely have to move down the calls. Okay, to roll down the remainder of the calls, what I need is like a green candle to form slightly so that these expand to something like 24. And at that point, it'll be a good call to move down the calls, taking an additional call side risk. Okay, looks like waiting is not going to do me too much good. So for now, even if it is at slightly bad pricing, we'll take off. The reason for that is we held 3 entire candles at 15,800 and there was no buying. And Reliance continues to make this steady down move when considering that there are a lot of positions on Reliance built up around 2,200. We might see a dip all the way till 2,200. So waiting is not going to do too much good. Right now, there is a slight spike in IV where the calls haven't really decayed in the last 15 points. They've held the same range and the puts are increasing in value. So that is not a great scenario, but it invariably means that kind of IV spike has to also fall off at some point, where either calls will lose value or there'll be an up move and the puts will lose value. So one of the two will happen. We're centering around 15,800 and yeah, 15,900 call really taking off now with 60 lakh contracts. So we'll keep you posted. Time is 10:30. So far, Bank Nifty and IT have been relatively sideways. Bank Nifty slightly negative bias, but Reliance is just taking some pain. Also, every other index is also in the red, so except for FMCG. Okay, looks like once again we're breaking 15,800 on the downside. I would not expect too much downside from here, even if you see how risk is being priced. The 15,800 call is trading 5 points higher than the 15,800 put, even though it's 8 points in the money. It shows market bias. Relatively, market has not believed that there'll be too much of a dip below 15,800. So this IV based spike on the 15,700 put is perfectly all right. And for now, considering that we are basically centered almost delta neutral at 15,800 should give us some confidence. What I'm expecting is that we'll potentially have a dip all the way till 15,770, something like that, to really create a panic and get people out of their lungs. And after that, should not be too much downside. It's more or less what I'm working with. If we start heading to 15,750 on the downside, then we'll once again roll down these calls and take an additional call side credit, because at that point it'll not make too much sense uh, to retain a bullish view when the market is pushing us out. So I've used a slight pullback candle to shift 1/3 of my calls to 15,850. If we head back to 15,800 on the spot, then these will get squared off and move back up to 15,900. If we don't and we continue to head lower, then I'm expecting a bounce from here. But this bearish position that was created was to balance against a runoff down move. So it's more like I'm willing to give up some of the reward in order to protect my downside further. So that's more or less the thought process here. So depending on what happens now, if we have a return of 15,800 and hold there, or have some kind of momentum on the upside, then we'll quickly get out of these and move them back up here. Okay, right now I'm taking a little bit of direction risk, but what I'm going to do is there's a big fall off in put side IV, and without a corresponding increase in call side premiums, I have the option to take off risk on the 15,850 call and move it back to 15,900, because the puts no longer need much protection. So that's exactly what I'm going to do on the 1/3 of the position. Basically, the idea is more or less that I mean, if you notice from what I said just a few minutes earlier, that there will be a dip almost exactly till 15,770, and then a reversal above 15,800. Now that could be seen from the fact that there's a big crash in the put side IV without a corresponding increase on the call side. So wanted to get out of these calls before they started getting covered at the earliest. Yes, it is direction risk, because the pricing of the options might have misjudged the potential buying back, and then there still could be a further dip once again. But my view was that that would not happen. And despite moving the calls away, these calls are also gaining a little bit. Okay, one more thing to note now is that along with the dip and rise below 15,700, a lot of, in the same period, a lot of 15,800 calls are being written. 15,800 call is now 52 lakh, which is 10 lakhs more than the 15,800 put. So a lot of bearish positions have been created into the dip. This creates double whammy type situation where, since these guys have gone short, and if you notice, they went especially short into the rise. So a lot of people waited for the rise back to 15,800 and then shorted the 15,800 call. That puts us in a situation where now there are a lot of shorts in the system, and if we don't have too much downside below 15,800, or we start holding near or at about 15,800 for a while, then the shorts will have to cover, and that might push us higher, because the shorts initially have been created because there's not too much expectation of upside, and 15,900 is now starting to look like in ceiling territory. And meanwhile, this is going to be interesting to see how this plays out. At the same time, there's no addition, but there's also not too much unwinding of the 15,800 put. So one way of interpreting it is that those who are short the 15,800 put are using the rise to short the 15,800 call in order to protect against further downside. Regardless, I mean, it's one of those two situations. I have a good amount of spacing as it is. My puts are still 80 points away from the money, so I'm not too concerned about continued down move. I mean, worst case, what I'm going to do now, rather than taking in additional call side credit, I will just take risk off on this put by moving it to the 15,650 if we have a continued down move. So it continues to be the same thing. Upside above 15,800 is being limited because of the kind of call shorts that are built up at 15,800 and higher. So like I said, it works both ways. It also means that if we don't see that downside and we see upside inside instead, then it can lead to a quick up move. So those are the two situations. Um, Given current pricing of options, there shouldn't be too much of a move. So these could potentially both be boundary strikes for tomorrow's expiry. Regardless, at this point, I'm just trailing stop loss as well as potentially going to adjust if there is some kind of a proper breakdown move to 15750. Okay, so power grid results are tomorrow, and currently the IVP is 99%, and at the money IV is almost 50. So different at the money IVs are high for different kinds of stocks. So I will be taking this trade. So this trade gives us 225 on the downside and 255 on the upside, roughly. So that's above recent swing high with like about 8 days to go for expiry after today. You can say somewhere around there is our upside break even. Yeah, you get the idea. Basically, very wide break evens due to the high IV and expectation of some big move post the results. We're getting very good premiums if you go and see positions. Generally, short straddles are good trades when IV is high, and for its IV can be high for some stocks by default because they're those kind of stocks, and IVP is high. With 99% IVP, it means that the IV is higher than 99% of the time of what it is for power grid. So taken. Okay, had to deal with a shakeout candle, which more or less had forced me to move out of the 15700 put. I couldn't record that because I had to act very fast. But basically, there's a big red candle at which point Bank Nifty got pulled below 35,000, and from here to here all the way testing till 15750, and that led to a big IV spike on the puts, the 14700 puts. So decided to take an exit. I used a panic exit on the entire position, which gave me some amount of slippage, but it was in case there is some kind of a further cascade, because yes, there have been bearish positions building up all day, call writing at 15800, but yeah, so I had to take a quick exit, and then once things stabilized, took a re-entry with a very risk averse spread, which is 15600 and 15900. So basically sorry, 15950, staying way out of any potential range for this expiry, and that way perhaps try and capture a little bit of the decay that is possible. In fact, if you see between our hedge and the premium in our sold strike, there isn't much of a difference. There's about 7 points, 7 points, 8 points, like that. So I will keep you posted. That was very unfortunate that but a quick 50-point candle like that can take you out. And it's better to exit in such situations than to not, because days low broke, Bank Nifty broke 35,000. So I had to give up quite a bit due to that, but it's all part and parcel. We'll keep you posted. The time is almost 1 o'clock. Now what I'm expecting is the best case scenario. I can probably capture about 2 to 3 points in the spread, nothing more than that. We'll keep you posted. One thing that I might consider doing is just cutting out of the hedges and reducing my strangle sizing, so that I don't have to lose to these hedges losing any value. Okay, some odd action now. Bank Nifty continues to look extremely weak, now below 35,000, but IT is showing some strength, and Reliance is more or less holding on 10-15 points above 2,200. Right now, there will be random spiking and falling in this relatively what can be considered now super OTM options due to the nature of small fluctuations, but it'll be very difficult to trade close to the money with the current pricing. It'll be very difficult to trade close to the money. Instead, keeping this kind of a range should just benefit from the fact that today is a Wednesday, and these options are probably going to open for less than $5 or so tomorrow. So some of that fall off can happen today itself. One good thing that's happening is because a lot of people are selling calls, they're buying calls as hedges, and that's why this super OTM call is actually benefiting quite a bit from that. Anyway, time is 1 o'clock. Got 2.5 hours to go. I'll keep you posted. But so far, it looks like the dip is more or less getting bought. That panic candle that would have pushed a lot of people out did its job. Okay, so IT continues to take off, and yeah, slight amount of green across. Now, what is here like scary is if these guys are now forced to cover. I mean, I'm very, very far, so it's not something that I should particularly be concerned about. But if we take out 15,800 on the upside, I'll be squaring off these 15,950 calls. I'm probably selling the 16,000, and then that'll be the last trade. After that, just set a stop loss and take an exit, more or less. Yes, sudden amount of strength in IT. And Bank Nifty back up above 35,000 as well. So these are the two developments. Another thing which is very easy for people to say is look back, hindsight, and be like, boss, you paid 28 plus 17, almost 29 plus 18 for this. You paid 47 for this spread, and now it is trading only at 42. That's easy to say in hindsight because you weren't dealing with a cascading market where Bank Nifty just broke 35,000 and Reliance is looking weak as well, where potentially there could be continued downside. So you have to manage for risk. Yes, had you held on to the position, you would have held on to the mark to market and then benefited an additional clear 6 points. But it doesn't work that way. And you invariably, unless you have like a set stop loss in mind, unless you're like, I'm going to let it run until a stop loss of X is hit, and then there's high likelihood that stop loss hits and then the market normalizes. I mean, even though the range has been quite small, a little bit more than 100 points or so, it will be a tricky day because, I mean, the market isn't pricing in much movement. We open gap down, middle low, and a steady almost 80-point up move from there. There went back crashing down, looked like 15,800 would hold, that didn't, and it broke very suddenly, another 50-point down move. And then a big recovery from there. So it's easy to say, yeah, 15,800 straddle would have made money, but it's difficult to stay in that position. And sometimes staying in the position when you shouldn't can do enormous damage to your capital. So anyhow, I guess for now I'm just not too concerned with either the up move or the down move. I just don't want there to be some kind of IV spike wherein the super OTM options retain their value even at the end of the day. There is a Fed meet later on in the evening in the US, so yes, there will be some value in OTM options, but shouldn't be too much is what I'm working with. Okay, so we're seeing an up move now, contributed to by everything broader market just lifting up, pulling us over 15,800. The thing is, I have a feeling most of these calls that were written at 15,800 were done so to cover longs that are already in the system. So you're seeing some unwinding. This was up to 65 lakh. Now 2 lakh has been unwound at 14,800. A reason I would think it's unlikely that we have a big short covering despite all these calls being here is because most of them were probably put in place to protect existing longs and not with an intention that the market has some big downside. So at this point, not too concerned. These calls are not going to expand much. First thing we'll have to see the 15,850 and 15,900 feel threatened of short covering, which isn't particularly the case at this point. So since there's no threat there, I'm not expecting much of a threat here either. Okay, there's a continued up move now, and there is potentially threat of short covering. And because of the nature of this IV spike, the puts are not losing any value, and the calls are gaining value. So I will just take an exit at 2 o'clock. Don't want to deal with some kind of a continued up move if it does come. It was a relatively not the easiest day to trade. I'm actually, I wouldn't nitpick, but I'm fine with how I traded as well. I think I did more or less what I would have done in such circumstances. I think one way of looking at it is should have kept slightly more in mind that this is lately been a buy on dips market, and every time, whether notice or not, the dip invariably is always getting bought That doesn't mean you can throw risk management out the door into an aggressive down move. But yeah, just as aggressively fell down, that aggressively heading back up. A huge amount of calls that was shorted. That's why I'm exiting, because it just means that there's a frenzy to cover that can push us up to a new day's high. Very, very possible. And when premiums available are peanuts, it doesn't make any sense to take on that trade. Okay, so the question will be, if tonight there is no big event that takes place in the US, and tomorrow there's a fall in IB, the value by which this strangle expiring next week, sorry, this week will lose will be much lesser than what this will lose. So I will be booking the Bank Nifty position as well. So this is currently giving us a 2.6% profit. And what I will be doing is exiting this. I'll probably wait till the end of the day and I'll exit this. But currently the hedges are giving us a loss of slightly under 3.5 lakhs, and the short side is giving us a profit of 4.3 lakhs. So that's about it. So my idea will be close this towards the end of the day and not take any calendar today. Wait for there to be a further fall in IB, after which will take place tomorrow if it's a non-event from the Fed today. And at that point, just create a new calendar. Also, this high IV short straddle, after taking it, the IV has continued to increase. So for now, it's showing a mark plus, but I'm not very concerned about it because there hasn't been any move as such in the underlying. So no move as such, just that there's a continued increase in IV, which is perfectly all right. Thank you so much for watching. Today was a little bit tricky. Could have been managed better if I had a slightly more aggressive view in terms of the dip getting, but I'm perfectly all right with the outcome. Thank you so much for watching.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.